At 6:47 a.m. in Moscow, the doors stayed shut. A TMS went dark across the city. Screens flashed error codes. Lines formed anyway. By 8:15 a.m., queues stretched for hundreds of meters. Pensioners, office workers, parents holding phones, refreshing banking apps. Nothing moved. No cash, no transfers, no explanations. Overnight, between 2 and 3 million bank accounts were frozen across Russia. Cards blocked, salaries trapped, savings locked. According to Russian banking data cited by Kommersant, this happened in less than 3 weeks, nearly 10 times the normal monthly average. No cash left, Moscow on Brink. This was not a cyber attack. This was not a system failure. This was policy. Inside the Central Bank of Russia, a new directive, Order OD-2506, had flipped the switch. AI-driven monitoring systems began scanning every ruble, every transfer, every withdrawal in real time. Not just large sums, not just elites, everyone. A pensioner moving $50, a student paying tuition, a small business wiring money to a supplier. Flagged, paused, frozen. Banks called it temporary. 48 hours, they said. But for millions, those hours stretched into days. Rent was due, food prices were rising, interest rates hovered near 25%, and Russia was still burning an estimated $800 million per day on the war in Ukraine. Then came the whispers, leaked reports, quiet admissions from inside the system. This wasn't about fraud. This wasn't about safety. This was about survival. Because behind the locked ATMs and frozen apps lay a darker truth. Russia's war economy was bleeding cash faster than it could be replaced. Oil revenues were falling, reserves were thinning, major banks were sitting on massive holes measured in hundreds of billions of rubles. And then the unthinkable happened, straight into the pockets of its own people. To understand how Russia reached this moment, the story must rewind years before the frozen screens and silent ATMs. Russia's economic model has long rested on a simple equation. Energy exports fund the state funds stability, and stability keeps politics quiet. For 2 decades, oil and gas revenues covered inefficiencies, corruption, and structural weakness. When prices surged, Moscow felt invincible. When sanctions arrived after 2014, the system bent but did not break. The full-scale invasion of Ukraine changed everything. By 2025, the war had transformed from a short campaign into a grinding war of attrition. According to estimates cited by Reuters and Defense News, Russia was spending hundreds of millions of dollars per day on weapons, logistics, salaries, and compensation. Precision missiles costing millions were fired against targets defended by drones worth a few thousand. The imbalance was brutal. At the same time, sanctions tightened. Europe slashed energy imports. Russia rerouted oil to Asia, often at steep discounts. According to reporting by the BBC and Deutsche Welle, oil and gas revenues dropped by roughly 24%, while non-energy tax income fell by about 13% year over year in 2025. The budget gap widened. To contain inflation, the central bank raised interest rates aggressively. By late 2025, rates hovered near 25%. Borrowing collapsed. Investment stalled. Companies survived on credit taken under far better conditions years earlier. Now, those loans were coming due. This is where the system cracked. Russia's banking sector is not a neutral marketplace. Major banks are extensions of state power and state-owned giants. When energy revenues weaken, banks feel it first. Loans tied to construction, transport, and regional governments turn toxic. Balance sheets rot quietly. By early 2026, internal reports cited by Kommersant and Business.ru revealed the scale of the problem. 2/3 of Russian companies struggled to service debt. Consumer loan delinquency surged toward levels last seen during the 2008 global financial crisis, with roughly 13% classified as problematic. Against this backdrop, the Kremlin faced a nightmare scenario, a loss of confidence. If citizens rushed to withdraw savings, the system would unravel. Sanctions had already limited access to external capital. Reserves were finite. A bank run could cascade within days. So Moscow chose control over confidence. Order OD-2506 was introduced under the banner of anti-fraud. In practice, it granted banks sweeping authority to halt transactions using 12 broad criteria, many triggered by everyday behavior: transfers between friends, same-day payments, cash withdrawals following digital transactions, cross-border movements, even small ones. The goal was not precision, it was friction. By slowing money movement, the state could trap liquidity inside the system. By freezing accounts, it could buy time. And by doing so quietly, one citizen at a time, it could avoid panic, at least temporarily. This was no longer a financial policy. It was a containment strategy. The first signs appeared quietly. A small business owner in Ryazan tried to pay a supplier. The transfer stalled, the account locked, phones rang unanswered. Within hours, payroll was missed. By the next day, production stopped. This scene repeated itself across regions, sectors, and cities. Then the pace accelerated. In Moscow and St. Petersburg, banking apps began issuing automated warnings. Transaction under review. Temporary restriction applied. No human contact, no appeal process. Algorithms decided. According to data cited by Kommersant, millions of cards and accounts were blocked in a matter of weeks, overwhelming bank call centers and regional branches. No cash left _Moscow on Brink. Unexpected twist number 1 came from scale. These were not oligarch accounts, not offshore networks. The majority were ordinary citizens, pensioners moving small sums, parents paying school fees, workers transferring wages to relatives. The criteria were so broad that avoiding them became nearly impossible. Borrow money from a friend, pay a bill the same day, withdraw cash afterward. Flagged. Unexpected twist number 2 followed quickly. Even businesses linked to state contracts were hit. Logistics firms supplying regional infrastructure projects found accounts frozen mid-payment. Truck fleets stopped. Construction sites paused. The ripple effects spread outward faster than officials expected. Banks tightened further. Cash withdrawals were limited. Branches shortened hours. A TMS ran empty not because cash vanished, but because replenishment slowed. According to business.ru, banks were instructed to prioritize system stability over customer convenience. In plain terms, liquidity was being rationed. The third twist was psychological. Social media filled with screenshots, frozen balances, error messages. Anonymous posts warned friends to pull cash. Others advised gold. Some whispered about crypto. Trust evaporated faster than rubles. The Kremlin reacted by closing ranks. State media emphasized safety. Officials repeated the word temporary. Meanwhile, enforcement expanded. Fast payment systems came under scrutiny. Even small peer-to-peer transfers triggered reviews. The message was clear. Money was allowed to exist, but not to move freely. Inside the banking system, pressure mounted. According to leaked summaries referenced by economic analysts, one major institution faced a 600 billion ruble gap tied to unrepaid loans and collapsing asset values. Another major bank acknowledged that problematic loans could surge towards 7% of its portfolio. Executives avoided the word crisis, but shareholders heard it anyway. The corporate debt spiral tightened. Companies borrowed at low rates years earlier. Now they faced refinancing at levels near 25%. Revenue lagged behind inflation. Costs surged. Defaults rose. Banks absorbed losses. To compensate, they restricted credit further, pushing more firms toward insolvency. The consumer sector followed. Households anticipating price hikes had loaded up on credit to buy cars, appliances, even food. Inflation erased wage growth. Debts piled up. By late 2025, consumer loan stress reached levels comparable to the global financial crisis era, and every frozen account served a dual purpose. It slowed withdrawals, it trapped cash, it delayed panic. But panic doesn't disappear. It waits. Lines outside banks grew longer, conversations grew quieter. People stopped trusting screens. They counted bills by hand. They searched for alternatives. The economy did not collapse in a single moment. It began to choke. What began as a technical banking measure quickly evolved into a systemic shock with consequences far beyond frozen accounts. Economically, the immediate impact was liquidity paralysis. When money cannot move, commerce slows. When commerce slows, tax revenues fall. According to reporting by Reuters and analysis cited by Deutsche Welle, Russia entered 2026 with a budget deficit near 2.6% of GDP, even after aggressive tax hikes. This was not a spending problem alone, it was a revenue collapse. Oil and gas once covered everything. That shield is gone. In 2025, Russia's energy income fell by roughly 24%, while other tax revenues dropped around 13%. Discounted exports to Asia could not replace the European market. Transportation costs rose. Insurance premiums surged. Payment channels narrowed. Every barrel earned less. To compensate, the state turned inward. Value-added tax climbed toward 22%, with higher rates for selected goods. Corporate taxes followed. Households paid more, earned less, and borrowed at punishing rates. Inflation outpaced wages, purchasing power eroded month by month. The social impact was immediate. Pensioners felt it first. Fixed incomes met rising food prices. Frozen accounts meant missed payments. Families delayed medical care. Small businesses postponed hiring or shut doors entirely. According to labor data cited by international analysts, Russia faced a shortage of roughly 4.8 million workers, driven by mobilization, emigration, and demographic decline. This labor gap magnified every weakness. Factories lacked skilled staff. Transport networks strained. Even banks struggled to maintain branches, relying increasingly on automated systems that worsened customer frustration. When an algorithm froze a business account mid-transaction, suppliers waited, employees waited, and local economies stalled. Militarily, the strain fed back into the war effort. Russia continued to spend an estimated hundreds of millions of dollars per day on operations, according to Defense News assessments. Ammunition stocks required replenishment, equipment needed repair, logistics demanded constant funding, yet each ruble diverted to war tightened the squeeze at home. This created a strategic contradiction. The war demanded cash flow. The economy demanded stability. The banking freeze provided neither. Financial repression became a substitute for reform. By trapping deposits, authorities delayed inflationary pressure and postponed bank runs, but this came at a cost. Confidence. According to BBC analysis, trust in formal financial institutions dropped sharply as citizens sought alternatives outside the system. Some hoarded cash, others turned to precious metals. A smaller tech-savvy segment explored digital assets despite restrictions. The state responded with tighter controls. Plans to expand the digital ruble project gained urgency. Scheduled for wider rollout in 2026, the system promised efficiency and transparency. Critics saw something else. Programmable money, transaction limits, and real-time oversight. According to experts quoted by Janes and DW, such systems allow unprecedented control over economic behavior. From a strategic standpoint, this marked a shift. Russia moved from managing an economy to managing movement itself. Money became less a medium of exchange and more a permissioned tool. This reduced panic in the short term, but increased resentment over time. Historically, this trade-off is dangerous. When households lose control over savings, loyalty erodes. When businesses cannot plan, investment collapses. When banks stop intermediating and start enforcing, the financial system loses legitimacy. The Kremlin's measures slowed collapse. They did not reverse it. They bought time. Time paid for with trust. Russia's financial lockdown did not unfold in isolation. Its shockwaves rippled far beyond Moscow, pulling in allies, rivals, and global markets. For NATO and the European Union, the frozen accounts confirmed a long-standing assessment. Sanctions were not a single strike, but a slow compression. According to Reuters and BBC reporting, Western policymakers viewed the banking restrictions as evidence that Russia's internal buffers were thinning faster than publicly admitted. The system was no longer absorbing pressure. It was redistributing pain inward. The contrast with NATO economies was stark. While Russia rationed liquidity, the United States and Europe relied on capital markets, debt issuance, and monetary flexibility. Washington funded advanced fighter jets costing over $80 million each, while Ukraine countered with drones often priced below $5,000. This asymmetry reshaped modern warfare. Cheap systems drained expensive ones. Time favored adaptability, not mass. China watched carefully. Beijing had become Russia's primary economic lifeline. Energy exports shifted east. Trade volumes increased. But this relationship was unequal. China demanded discounts, yuan settlements, and strategic concessions. According to analysis cited by Deutsche Welle, Russia was sliding into junior partner status, dependent on Chinese demand and logistics routes. Financially, China offered no bailout. Beijing avoided direct exposure to sanctioned banks. Chinese firms complied selectively with Western restrictions to protect global access. The message was subtle but clear. Partnership did not mean rescue. The Middle East added another layer. Russia sought alternative financial channels through energy cooperation and arms deals. Yet oil markets remained volatile. Production cuts stabilized prices briefly, but demand uncertainty persisted. According to defense news and energy analysts, discounted Russian crude undercut partners, limiting long-term gains. Meanwhile, the United States recalibrated. With Donald Trump back in the White House, Washington emphasized transactional leverage. Frozen Russian assets remained a bargaining chip. Any discussion of release came with conditions tied to conflict de-escalation and compliance. According to major U.S. media, no rapid resolution was on the table. Globally, analysts began modeling scenarios. In the next 3 months, the banking freeze could prevent a full-scale run, but at the cost of business contraction. GDP growth would remain flat or negative. Inflation pressure would stay elevated. In the 6-month horizon, experts cited by Reuters warned of deeper risks. Continued war spending combined with shrinking revenues could force monetary expansion. That path raised the specter of rapid currency devaluation despite controls. Militarily, the implications were equally serious. Russia's doctrine relied on mass and endurance. Financial strain threatened both. Recruitment incentives grew costlier, equipment maintenance suffered delays, supply chains stretched thinner. NATO analysts noted that economic pressure increasingly shaped battlefield tempo. Cheap drones versus costly missiles became a metaphor. One side spent cash freely, the other counted rubles carefully. Strategically, Russia faced narrowing choices: end the war and accept loss of prestige, continue the war and deepen domestic control, or attempt isolation modeled on heavily sanctioned states, trading openness for command. Each path carried risks, none promised relief. The global system adjusted accordingly. Markets priced in prolonged instability. Governments planned for a drawn-out confrontation. And Russia's internal financial clampdown became a case study in modern economic warfare, where the front line runs through bank accounts, not borders. What unfolded in Moscow was not a temporary banking disruption. It was a signal. Frozen accounts, silent ATMs, algorithms replacing trust. Together, they revealed a state under pressure, choosing control over confidence. The Kremlin framed its actions as protection. The data told a different story. When millions of accounts are halted, when interest rates hover near 25%, when energy revenues fall by nearly a quarter, and when the war continues to burn hundreds of millions of dollars every day, the system is no longer managing risk, it is containing it. This financial lockdown exposed a deeper rupture. For years, an unwritten social contract held: political quiet in exchange for stability. That balance has shifted. Stability has faded. Prosperity has narrowed. And money, once the symbol of personal security, has become conditional. Strategically, the Kremlin faces a narrowing corridor. Printing money risks inflationary shock. Ending the war risks political damage. Tightening control risks social fatigue. Each option carries consequences that compound rather than resolve. Globally, the message is just as clear. Economic warfare has evolved. Sanctions no longer aim only at governments. They compress entire systems until states turn inward. When that happens, the front line moves from borders to bank screens, from trenches to transaction logs. The coming months matter. Will financial controls succeed in preventing panic, or will they accelerate loss of confidence? Will continued war spending force deeper intervention into private savings? And can a system built on restriction sustain loyalty without growth? These questions remain open. What is certain is this: the war's cost is no longer measured only in territory or equipment. It is measured in frozen balances, delayed wages, and trust withdrawn one account at a time. Now it's your turn. Do these financial controls stabilize Russia or weaken it from within? Can economic pressure reshape strategic outcomes faster than military force? And what is this signal for future conflicts where money itself becomes the battlefield? Share your thoughts in the comments. Subscribe for deeper geopolitical and military analysis. Turn on notifications so you don't miss the next